Let me tell you something that I genuinely believe most people, including most sophisticated investors, most policymakers, and most economists, are not prepared for. The petrodollar system, the architecture that has quietly underwritten American dominance for the last 50 years, is ending. Not metaphorically, not gradually as a theoretical possibility. It is ending right now, in real time, in front of all of us, and yet, because it is happening through a long arc of history rather than a single dramatic collapse, almost nobody is treating it with the urgency it deserves. I've spent the last several decades studying the rise and fall of reserve currencies going back 500 years. I've mapped the Dutch guilder, the British pound, the Spanish real, the French livre, and what I've found consistently is a pattern. A template. Empires rise, they accumulate wealth, they build the world's dominant currency, they overextend, they print money to cover their debts, and then slowly at first and then all at once, the world moves on. We are at that inflection point right now with the US dollar. And the petrodollar agreement is the linchpin. Let me explain what that system actually is, because most people use the word without understanding the mechanics. In 1974, after the breakdown of Bretton Woods and the oil shock that nearly fractured the global economy, the United States struck a deal with Saudi Arabia. The arrangement was simple and brilliant. Saudi Arabia would price its oil exclusively in US dollars. In return, America would provide military protection and strategic partnership. The other OPEC nations followed. And just like that, the entire world, every nation that needed oil, which was every nation, was forced to hold US dollars. Not because they wanted to, not because the dollar had gold behind it anymore, but because you couldn't buy energy without it. This single arrangement transformed the dollar from just another post-Bretton Woods currency into the gravitational center of the global financial system. It gave the United States what the French economist Valéry Giscard d'Estaing famously called an exorbitant privilege: the ability to borrow in your own currency, run persistent deficits, and export inflation to the rest of the world. For 50 years, the world absorbed that inflation because they had no choice. They now have a choice. In the last 5 years, we have seen a remarkable acceleration of what I call the de-dollarization trend. China and Russia began settling bilateral trades in yuan and rubles. India and the UAE struck oil deals in rupees and dirhams. Brazil and China announced direct currency swap arrangements. Saudi Arabia, the very nation whose agreement with Nixon created this system, began publicly discussing accepting yuan for Chinese oil purchases. The BRICS nations, which now represent over 40% of global GDP by purchasing power parity, are actively constructing an alternative payment infrastructure. None of this happened overnight, and none of it was an accident. What you are watching is the world's most powerful nations making a calculated, deliberate, multi-decade bet against the continuation of American monetary hegemony. And they are making this bet not because they are ideologically opposed to the United States, though some certainly are, but because the numbers no longer work for them. The United States is running a national debt approaching $35 trillion. It carries an annual deficit exceeding $1.5 trillion. It is a nation consuming far more than it produces, sustained by the one asset that cannot be manufactured: global trust in its currency. And that trust is fracturing. Here's what I want you to understand about cycles. When I show people the historical data, the timeline of every reserve currency over the last 5 centuries, they always say the same thing. Yes, but America is different. The British said that too. The Dutch said that too. Every empire at the peak of its power believes it sits outside the cycle. That belief is almost always wrong. Not because empires are weak, but because the very mechanisms of power that lift a currency to reserve status, the ability to borrow cheaply, to finance deficits through money creation, eventually undermine the discipline that made the currency trustworthy in the first place. This is not a political statement. I am not rooting for this outcome. I have spent my entire career operating within the framework of dollar-denominated global finance. But my job, and what I believe your job should be, is not to hope. It is to see clearly. The petrodollar isn't going to collapse in a single week the way a stock market crashes. It will decline the way empires always do, through a slow erosion of confidence, punctuated by moments of sudden, shocking acceleration. And when those moments arrive, the people who were not prepared will look back and realize that all the warning signs were there, visible to anyone willing to look. We are in one of those warning periods right now. I want to walk you through exactly what a post-petrodollar world looks like, not as a theoretical exercise, as a practical, operational reality that I believe is coming within this decade. First, let's be precise about what the dollar actually losing reserve status means, because the popular imagination tends toward catastrophism, and that misses the more important, more insidious reality. The dollar will not go to zero overnight. The United States will not wake up one morning unable to buy imported goods. What will happen is subtler, more corrosive, and in many ways more difficult to defend against. Here is the mechanism. As the petrodollar arrangement weakens, as more oil is priced and settled in yuan, in digital currencies, in basket arrangements, global demand for US dollars structurally declines. Central banks around the world, which have for decades held vast dollar reserves because they needed them to buy oil and settle trade, begin to diversify. Slowly, they sell dollars and buy alternatives: Chinese yuan, gold, euros, and increasingly, whatever emerges as the neutral reserve asset of a multipolar world. This selling creates pressure on the dollar's value. To defend the dollar and service its debts, the United States Federal Reserve faces an impossible choice, the same impossible choice that every declining empire faces. It can raise interest rates to attract capital and defend the currency. But those higher rates crush economic growth, explode the cost of servicing a $35 trillion debt, and crash asset prices. Or it can print money, monetize the debt, and debase the currency, which provides short-term relief but accelerates the very loss of confidence it is trying to arrest. There is no painless exit from this trap. There never has been in any previous cycle. What there is, historically, is a period of instability, sometimes lasting years, sometimes a decade or more, during which the old reserve currency and the emerging challengers compete for primacy, and ordinary people and institutions that did not prepare are devastated by the volatility. Now, think about what this means practically. Oil, priced in dollars, has allowed the United States to import energy at what amounts to a subsidized rate for 5 decades. When oil begins to be priced in other currencies, which is already happening at the margins, American energy costs will be subject to real currency market discipline for the first time. Inflation in the United States will have a structural floor that it has never had before, not the temporary supply shock inflation we saw in 2021 and 2022. A permanent, embedded inflationary pressure baked into the price of everything that requires energy to produce or transport, which is, of course, everything. Interest rates will be forced higher, not because of Federal Reserve policy choices, but because the United States will need to offer genuine, competitive returns to attract the foreign capital it needs to finance its deficits. For 40 years, being the reserve currency meant borrowing at preferential rates. That subsidy ends when the reserve status erodes. The bond market, the largest financial market in the world, a market that has functioned for decades on the assumption that U.S. Treasuries are the risk-free global asset, will face a profound repricing. I want you to sit with that for a moment. The risk-free rate, the foundational number from which every other asset in the world is priced. When that foundational assumption shifts, everything built on top of it shifts. Now, I am not predicting a single catastrophic event. What I am predicting, and what history supports, is that the transition from one reserve currency arrangement to another is always messy, always disruptive, and always most damaging to those who assumed the status quo would last indefinitely. The transitions that look cleanest in the history books were brutal while they were happening. The decline of the British pound as the world's primary reserve currency, which accelerated after World War II and crystallized with the Suez Crisis of 1956, cost British citizens a decade of relative poverty, currency crises, and painful austerity. And Britain was not at war. Britain was simply no longer the center of gravity. What makes the current moment more complex and more dangerous is that it is happening simultaneously with the rise of a genuine peer competitor. China today is not just offering an alternative currency. It is offering an alternative system, alternative payment rails through SIPs and now BRICS payment platforms, alternative multilateral institutions through the Shanghai Cooperation Organization and the New Development Bank, and alternative diplomatic relationships that specifically bypass the dollar-denominated world. The transition from the pound to the dollar happened within the Western alliance system. America and Britain were partners. The transition from the dollar to whatever comes next is happening across a genuine geopolitical fracture. That makes it far less orderly. The people who are not ready for this are not stupid. They are simply operating on a mental model that was accurate for 50 years and is now quietly becoming obsolete. The map has changed. Most people haven't updated the map. So the question I get asked most often in every context, from individual investors to sovereign wealth fund managers, is, what do I do with this? And I want to answer that honestly, which means I have to start with something uncomfortable. There is no perfect hedge against a reserve currency transition. There is no asset you can buy that immunizes you completely from what I've described. Anyone selling you that certainty is either lying to you or fooling themselves. What there is, and what I've spent my career building at Bridgewater, is a framework for thinking about risk that does not depend on a single outcome being correct. We call it all-weather. The principle is simple. You build a portfolio that is balanced across different economic environments, growth, decline, inflation, deflation, so that whatever environment materializes, you are not catastrophically exposed. In a world where the foundational monetary architecture is shifting, that principle becomes not just prudent but essential. Let me be specific about what I believe smart money is doing right now and what I believe ordinary individuals should be thinking about. Gold. I know this sounds like something from a different era. For decades, gold was dismissed as a barbarous relic, a yield-free asset for pessimists. But gold is the one reserve asset that no nation controls. It cannot be sanctioned. It cannot be frozen. It cannot be debased. When we look at what central banks around the world are doing, not what they are saying, we see a historic accumulation of gold reserves. China, Russia, India, Turkey, Poland, Hungary nations across the geopolitical spectrum are buying gold at rates not seen since the 1960s. They are not doing this for sentimental reasons. They are doing this because they are building balance sheets that do not depend on American goodwill. That signal matters. Commodities broadly. In a world where the petrodollar weakens and energy is repriced in real terms, physical resources, oil, copper, agricultural commodities, rare earth minerals will hold value in ways that financial paper will not. The great commodity supercycle of the coming decade is, in my analysis, directly tied to the monetary transition I've described. Geographic diversification. This is something most individual investors dramatically underweight. When a single nation's currency has been the global reserve, it creates the illusion that holding assets denominated in that currency is the safe default. It is not. Spreading exposure across multiple currencies, multiple legal systems, and multiple geopolitical spheres is not paranoia. It is basic prudence that most of the world's wealthy families have practiced for centuries. Hard assets over financial claims. In any inflationary, currency unstable environment, the hierarchy of value shifts. A financial claim, a bond, a bank deposit, a currency is only as good as the institution that backs it and the purchasing power of the unit it is denominated in. A hard asset, real estate in a stable jurisdiction, a business with genuine pricing power, productive farmland, energy infrastructure holds value because it is a physical reality, not a promise. I also want to say something about what to watch, because the timeline matters. The single most important indicator I am watching is Saudi Arabia. The 1974 agreement was bilateral, and its unraveling will also be bilateral. When Saudi Arabia formally, publicly, and structurally begins accepting non-dollar currencies for oil not in quiet bilateral deals, but as a declared policy, that is the moment the world will understand that the system has fundamentally changed. That moment has not arrived yet, but the trajectory is clear. I also watch the U.S. fiscal position. Every year that the United States runs deficits exceeding $1 trillion with no credible political will to address the structural imbalance is a year that accelerates the loss of confidence I described. The mathematics are not ideological. At some point, debt service consumes the federal budget. At some point, foreign creditors demand a risk premium to finance American spending. That premium will arrive. The only question is when. Let me close with something I want you to hold on to. The people who navigate great monetary transitions successfully are not the people who predicted the exact date and mechanism of collapse. They are the people who understood that cycles are real, that no monetary system lasts forever, and that preparation, thoughtful, diversified, humble preparation is far more powerful than any specific prediction. I have studied empires and their currencies for most of my adult life. What I know with confidence is this: the petrodollar system is the most consequential monetary arrangement in modern history. It shaped the world you live in, the prices you pay, the interest rates on your mortgage, the cost of your government's debt, the global power of the country you live in. And it is changing. Most people aren't ready for that. The question is whether you will be.